Hello, this is Chaz Bicknell with Barrett Financial Group. If you're new to real estate investing, you've probably heard the terms residential and commercial lending. But do you really know the difference? And more importantly, why it matters for your investing strategy? Today I'm breaking it down so you can make smarter, more profitable decisions, whether you're buying your first rental or scaling up to commercial real estate. Let's dive in. Let's start with residential lending. Residential loans are what most people are familiar with. Think mortgages for single-family homes, duplexes, triplexes, or fourplexes. These loans are typically backed by government-sponsored entities like Fannie Mae or Freddie Mac. They're based largely on your personal income, credit score, and debt-to-income ratio, just like when you buy a home to live in. If you're investing in a small rental, you'll probably start here. Why? Because the terms are typically better. Lower interest rates, longer repayment periods, and you can even buy with as little as 10% down in some cases. But here's the catch. Most residential lenders will only let you finance up to 10 properties before you hit a wall. That's when commercial lending comes into play. Now let's talk commercial lending. Commercial loans are for properties with 5 or more units or non-residential buildings like retail spaces, office buildings, warehouses, or flex space. Here's the key difference. With commercial lending, the loan is based more on the property's performance and less on your personal finances. Lenders care about things like the net operating income, NOI, the debt service coverage ratio, DSCR, the stability of your tenants, and the location and condition of the property. That means your credit score still matters, but the property itself does most of the talking. Let's break it down, the biggest differences side by side. So for residential loans, equal personal income base. Commercial loans is property income based. For residential, you can usually do 1 to 4 units, and for commercial, it's 5+ units or non-residential. Residential is usually lower rates and longer terms. Commercial is higher rates and shorter terms, but much more scalable. Residential is a limited portfolio growth, whereas commercial is unlimited scaling potential. So if your goal is to build a big rental portfolio or invest in larger cash flowing assets, understanding commercial lending is a must. Here's why this all matters. If you're just starting out, you'll likely begin with a residential loan because it's easier to qualify for and often much cheaper. But if you're serious about building wealth through real estate, you'll eventually want to graduate into commercial investing. It gives you access to larger deals, more units under one roof, and in many cases, better economies of scale. So, learning the difference early can help you avoid hitting a ceiling when it's time to scale up. So let's wrap things up. Start with residential if you're new, but don't ignore the power of commercial lending. The earlier you understand how both systems work, the faster you can grow your portfolio and build long-term wealth. A little bit about me and the lenders I work with. I have over 210 lenders. 60 of them are commercial lenders. 160 of them are residential. There's a little overlap on each. I've been doing loans for 27.5 years, and I was also a CPA for nearly 20 years. That's why I can do so many things on the commercial side and help so many different borrowers. Anytime you have questions, feel free to reach out. Call me at 239-272-4442. See below for more details and information. If you like these videos, please like and subscribe and feel free to comment. Thank you.